All right, let's talk about a deal in the wild world of biotech that just completely shattered one of the biggest rules in business. We're going to get into the story of how a company called Alumis bought another, ACL Iron, and somehow got paid to do it. Yeah, you heard that right. This is a fascinating one.
There's this unwritten, well, pretty much written, rule in big-time mergers. It's basic. When you buy a company, you have to pay more than it's worth on paper. That's the premium. It's for getting control, for the future potential, whatever. You always pay extra. It's just the price of admission. But what happens when a deal comes along that just rips up that rule book?
Well, this is that deal. Just look at these numbers for a second. Alumis paid about 233 million bucks for Acelerin, but here's the kicker. The actual value of Acelerin's assets, we're talking their cash, their investments, their science, was worth over 454 million. That's not a premium. That's like buying something for 50 cents on the dollar. How on earth does that even happen?
So, to figure this out, we need to talk about this really rare financial move called a bargain purchase. You can think of it as a negative premium. It's the kind of thing that almost never happens, and it's the key to this whole story.
Because of that huge discount, Alumis got to book this number right here, an instant gain of nearly $211 million. The second the ink was dry on the deal, bam, that's profit on the books. And this isn't some fuzzy, maybe in the future kind of profit. This is a day-one accounting game that completely changes the game and acts like a massive safety net for the whole deal.
So what exactly is a bargain purchase? Well, honestly, it's pretty much what it sounds like. It's when you buy a company for less than its parts are worth. The analogy here is perfect. It's like you buy a house for, say, $500,000, but when you walk in, you find 700 grand in cash just sitting there on the kitchen table. You're already way ahead before you've even started.
And that cash on the kitchen table, for Alumis, it was a whole lot. They got that immediate $211 million paper gain. They got over $410 million in actual cash and investments. And then, on top of all of that, they got the thing they were supposedly buying, a promising drug asset called lonigutamab, valued at almost $51 million. All of that for a price of just $233 million. It's pretty mind-blowing.
Okay, so what does a deal like this actually mean for the business? Well, a gain like this doesn't just look good on a spreadsheet. It literally flips the entire risk equation of a merger upside down. It lets us look at the whole idea of risk in a completely new light. And to do that, we can use a metric called shareholder value at risk, or SVAR. Just think of it as a worry meter for a big deal. It's a really simple way to ask a crucial question. If this whole thing goes completely south, worst case scenario, how much of our own company's value are we really putting on the line?
And this is where the magic really happens. Let's do some quick back-of-the-napkin math. You add up all the things that could go wrong. The cost of mashing two companies together, the risk that the drug they bought fails, the risk they burn through all that cash. All in, you're looking at a potential loss of about $230 million. But then, you get to subtract that massive $211 million bargain gain. It just acts like a giant shield, soaking up almost all of the potential damage. And what are you left with? The net risk is just 19 million bucks. When you stack that up against what Alumis was worth before the deal, it means only 7.3% of the company's value was ever truly at risk. In the high-stakes world of mergers, a single-digit risk factor like that is, well, it's almost unheard of. It's an unbelievably safe financial bet. This chart just says it all, doesn't it? Look at that. Almost 93% of any potential disaster is already covered by that built-in bargain. That tiny little sliver, that 7.3%, is the only part of Alumis's value that was ever truly in danger. This is what you call downside protection, and frankly, it doesn't get much better than this. But hold on. This doesn't mean the deal is a guaranteed home run. Not at all. The financial structure might be brilliant, but Alumis still bought a biotech company, and that means the danger is still very, very real. The risk just shifts away from the deal itself and onto the science. And the analysis really backs this up. The quote says it all. The main risks are now all about clinical execution, not the deal's economics. They nailed the finances. That part is done. Now comes the really hard part, making the science work, running the trials, and getting this new combined company to actually succeed. And this right here, this is the massive mountain they have to climb. That drug they bought, lonigutamab, is in what's called phase 2 trials. And historically, about 80% of drugs that get to this stage fail. They just don't work. So even though the financial risk is tiny, the scientific risk is absolutely huge. And to make things even more intense, there's a ticking clock. Remember that huge pile of cash they got in the deal? Well, running a biotech company is expensive, and at their current speed, they've got about 18 months of cash left. That's a year and a half to prove their science works before they run out of money.
So when you look at the road ahead, it's a real minefield. Right now, they have to integrate 2 companies. In 6 months, they need to make sure their best scientists don't leave. Within a year, they desperately need good news from their clinical trials. And all of this has to happen before that 18-month clock runs out. Every single one of these is a major hurdle.
So what's the big lesson here? Is this whole thing just a bizarre one-off? Or could this actually be a new playbook for smart companies trying to make moves in a crazy market like biotech?
Let's break down the key takeaways. On the one hand, you've got this massive win, incredibly low financial risk. It's an asymmetric bet. That's what investors dream of. Tiny, tiny downside, but massive potential upside. But, and this is a big but, the warnings are crystal clear. It all comes down to execution now. And you have to remember, a deal like this was only possible because of perfect market timing, when the whole biotech sector was down. And that kind of leaves us with this final, really interesting question. We always think of these huge deals as huge risks, but Alumis figured out a way to structure a deal where they were basically getting paid to sit down and play the game. So in a world that's full of high-stakes gambles, maybe the absolute smartest move is finding the one bet where you've already won before the cards are even dealt.